all these ETF allocations that people think they have gold is not owning gold. It's just owning a speculative asset that's virtually somewhere, but not really. And then the government can take it from you. That has happened in the past. When you work with these cyclicals, the best buy is when it looks ugly. When it's the companies, you say this is going bankrupt. That is the best time to buy. And if you know that there is value in what you're buying, you don't care about the price. If it goes lower, you're actually more excited.
Sven Carlin, YouTuber, value investor, and of course founder of the Sven Carlin research platform. It's a true pleasure to host you on Palisades Gold Radio today.
Thanks for having me. It's a pleasure to be here.
Excellent. Really excited to get this discussion going, Sven, talking gold for a second. Of course, the material is already up over 50% year to date. However, we have seen quite a sharp pullback recently. Is it something that's on your radar? What are your thoughts on gold currently?
So I think I have been looking especially at gold miners there in the late 2010s when nobody wanted to touch gold with a 10-foot pole. And now suddenly everyone is excited about gold. But even 5 years ago, I was saying when gold was 1,500, 2,000, that gold will reach 5,000. Now, I am sure that in the future, gold will reach 10,000. However, given what's going on, now everybody is talking about gold, and not the taxi driver anymore, but now the Uber driver is talking about gold, which makes it risky, especially these apps. I've seen the ETF inflows for gold just skyrocketing up, pushing the price up to 4,300, which means there is a lot of exuberance that makes it risky because these people buying gold now are speculators. Those are not the people that have exposure to gold and then adjust to, let's say, you buy more when it's down and you rebalance the position when it's up. And now I would say it is a speculative increase in prices, even if it will go to 10,000 in the future.
Understood. Of course, the time frame is always hard to judge. You were talking about ETF inflows for a second. Really interesting, of course, fact there. However, that has been ongoing relatively shortly, one could argue. And these gold bull markets tend to run relatively long. Does that change the equation?
Depends on what's going to happen and how the price is going. If the price keeps going up, it will attract more inflows. And then always, as with any small or bigger bubble, you can never predict that. But the recent pullback and perhaps people already being scared, or still the attractiveness of the stock market, AI and other things doing better, might then also change the picture. But if we talk from if there are any fundamentals in gold, you never know when there is so much speculative demand. It means now there is demand, but that means that 6 months later there can be supply because this is more about the speculative gain than other. Those who have, let's say, I always been saying that if you want to own gold, you own 7.5% of your portfolio. When it goes up, you trim it back. Now is the time to trim it back. Then if it goes lower, when nobody's attracted anymore, you bring it back to your, 7.5%.
Understood. So you would think for a value investor, minded investor that likes a diversified portfolio, low risk, there is still a world in which they could take up a gold allocation today.
I think it's a personal answer. So from a pure value investing perspective, it doesn't produce anything. And therefore, it's just a sentiment-driven demand and supply. And now people think they have an allocation to gold as protection, but from just if there is disaster or whatever, you need to have gold in a safe in your home so that you can use it in case you really start using gold. All these ETF allocations that people think they have gold is not owning gold. It's just owning a speculative asset that's virtually somewhere, but not really. And then the government can take it from you. That has happened in the past. So if you are a true gold owner, you own or gold or silver in the safe in your home that in case of disasters, you can use or sell. All these financial virtual gold owners, that's just igniting the speculative bubble.
All right, well understood. And what about gold miners? What we hear often from value-minded speculators is that gold miners are still trading at very attractive price to cash flow or price to NAV multiples because they've gone up less than the gold price has. Is that an area where you are willing to look for value and are finding value?
I have been looking, I think 2018, 2019, I have analyzed almost all the gold miners. I would go through the ETF and look at all of them, made even some money on those gold miners. But the problem with gold miners is that they are such destroyers of capital that it is incredible, because now and immediately gold prices start going up. They start chasing growth. They start chasing acquisitions, mergers. They start chasing investments that are not reasonable or rational. And then they promise growth. And then you look at the chart. Let's say you look at an investor presentation from Newmont, from all those players from 5 years ago. You look at their promises for now, and you see the actual production is going down, not up as they have promised. Therefore, they are such terrible capital allocators that you never know when that story breaks. And that's the problem all around gold miners. If you really want exposure, you might look now, perhaps not because the price is higher, at some miners that have, I don't know, copper and then gold as a side product. And that then gives you real cash flows when gold prices spike.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Well understood, quality is of course very important in these companies, and the discussion becomes even more muddy when you include per share metrics, not just total production numbers, especially for some of those majors you've just named. All
these mergers, I want to be the biggest gold miner, we want to have the most ounces, but all those mergers, things like that, acquisitions, is just pure destruction of capital, has been going on since the early 2010s, when it was all about growing gold production, and the management hasn't changed. Maybe they change companies or the lower management becomes the senior management, but it's all about chasing their incentives that are to get shares through mergers, to getting bigger market caps, not truly through delivering value to shareholders. It's not really their fault, because shareholders incentivize them to do more, to grow, to push the stock price higher, and that works for a while and then it doesn't. And that's always the problem with these gold miners. It works for a while until it doesn't. Always great to hear your contrarian takes, Sven. I would love to talk about the general stock market for a second. Recently, you've discussed your model portfolio on your YouTube channel, and I was actually surprised with how little cash you were holding compared to the opportunity set that's available out there. Well, I've recently, some of my Chinese exposure went up, and I said the next time China is in a boom, I will close that to reduce the risk. And now I'm at 10% cash, and as soon as I find something to deploy it, I will deploy it, because I still can, as long as I can find P ratios of 10 and good companies, I will be invested.
Can we talk about your value investment framework for a second? Of course, you referenced the PE multiple of 10 there. I suppose that's not everything that matters for you.
Of course not, but if you can buy a good business at a fair price and for whatever reason it is trading at a good earnings yield, I don't know, a dividend yield of 5-6%, or even not a dividend yield, but growing earnings at a good rate and reinvesting that at a good return on investment, there's nothing much to ask. I know that my businesses will deliver their 10% over the long term. When the market gets exuberant, I can trim them down or sell, buy something else. And if they keep on growing, I might even never sell them. So it depends on the situation. But for now, there are still some value investing opportunities in these small niche markets. Here and there are some opportunities in the commodities space, especially not now anymore. Things have gone up, but after Liberation Day, there was some coal, things like that were getting cheaper. So still, I think I discussed a few days ago on my channel, Amsterdam Commodities, the stock from the Netherlands. Small niche company, nobody watches it, it's not on Wall Street's radar. They have a 5.5% dividend yield, have been growing earnings 8% for the last 10 years. They just keep on doing their model, acquiring smaller businesses, implementing into their global ecosystem, which means they will likely, with inflation, 4% on food, 4% growth, organic, inorganic. And we are 7-8% earnings growth. So that's a 5% dividend plus 7% growth. That's 10-12% on food. That whatever happens with AI, I think we will still keep eating spices, organic foods, things like that, nuts, instead of just chips energizing our minds.
All right. Talking about the general broad market for a second, we hear it often that the market is overstretched, overvalued. When you look at the returns of the S&P 500 the last year, how much comes from the top 10 names within it? Is there still a lot of value to be found even in the United States if you're willing to do the work and go through the list and go to the smaller companies?
I haven't found much in the United States. You can find, for example, some value in companies that are listed in the States but have operations in Europe. Maybe some, I don't know, telecoms like Liberty Global or Nomad Foods that are businesses doing business in Europe, therefore Wall Street doesn't care about them, and you can find some value there. But in general, the market is extremely stretched. The cash flows are going down because everyone is investing into the AI revolution, which makes it even more riskier than it was 2 years ago when these companies were just keeping on doing their business. And now from asset-light businesses, the Magnificent Seven are turning to asset-heavy, heavy capex investment businesses, where the return on investment is totally unknown, which means it is just riskier and riskier, but stocks keep going up. Everybody's making money. Nobody cares about the risks. The Fed will lower rates when Trump puts his own Fed chairman. Rates will be at 2%. 2%. Stocks will go up another 20%. We have 1 trillion of buybacks coming in, 1 trillion already inflows from ETFs coming in. If you look at the inelastic market hypothesis, 2 trillion in times 5, given the market, that's 10 trillion up. That's still almost 20% up in the next 12 months.
Point well understood, definitely. Everything can continue to go up even if they're overvalued. I recently heard an interesting argument from Howard Marks, who argued that the quality of companies has also gone up in the US. So if you look at those top 10 names, like for example NVIDIA, the average multiple might be elevated. If you look at it to forward multiple or trailing 12-month multiple. But if you then compare for the growth rates that they're actually delivering as well as the quality of the businesses, it might be warranted.
I think NVIDIA expected revenues next year are 250 billion. I don't know what were the revenues 5 or 7 years ago. 10 billion. So there was an increase in 5 years, 25 times on great NVIDIA technological developments. Okay, but that was just one small company 5 years ago. And now I'm looking at AI being so smart and everyone going there. Who can guarantee me that 5 years from now, NVIDIA will still be the dominating power? If NVIDIA rose so quickly, how can I know that NVIDIA will be there again 5 years from now? Nothing prevents another player that now is maybe obscure, small, that does the same. If you compare Chinese AI with ChatGPT AI, it works. So who knows what will be the difference in 5 years? So companies, yes, everything looks great now, but I'm still missing the competitive advantages that will lead to long-term durable advantages, profits. Google disrupted by ChatGPT. Who knows how it will look like in 5 years? And all these situations. Apple, now a little bit of growth, but hasn't been growing really for 3 years and things like that. So it's really high uncertainty, high risk, therefore, in this case, for these businesses. Unknown moats, unknown durability of profits. Yes, everything looks good. Nobody can argue against that, but it happened a lot, many times in history that things looked good and that it didn't work out. 1960, what was it? Kodak, IBM were the NVIDIAs of this time.
Point well understood. I guess it all comes back to the risk-reward metric that you always like plotting. If the risk is really high due to the price that you're paying, but also due to it being high-tech and could be disrupted quickly, and the reward that you can expect is not that high, it's just not an attractive investment opportunity. I
mean, I'm happy that everyone makes their money. I sure don't want to see the Nasdaq falling 75% like it did in 2001, 2002, because it will simply destroy a lot of investors' portfolios and even pension funds. Most pension funds now have the highest allocation to NVIDIA because it's a 5 trillion company, therefore 8% of the S&P 500. So even, I don't know, the pension fund of my mother in the Netherlands is mostly long NVIDIA and the Magnificent Seven. So I'm certainly not the one who hopes it will crash because it will lead to so much pain. However, I don't know what will give me the certainty that it will deliver returns in the long term.
Well understood. I would love to shift to commodities for a second. I believe in agriculture, in the agricultural sector, you've been finding some interesting opportunities the last couple of months or perhaps even years. Why do you think this sector is so overlooked and therefore showing these opportunities?
It's boring. You pretty much, you can see, okay, this is the demand, there is so much people, these are the prices, and especially there was this inflationary boom in 2022, 2023, everybody was excited about it. Stocks were pushed up, like we discussed at the beginning with gold. It was a sentiment-driven momentum trade. And now those have simply returned back to, let's say, fundamentals. And if you look through these food companies, you can find them at P ratios of 10, dividend yields of 5%. And if you look at the long-term structural trends, more people in the world, they will likely eat. I don't know if AI will develop some recipes that I don't have to eat. I should lose some weight, but okay. And you have this certainty. But when I tell people, look, here, it's very likely you will have a return of 10% per year. And they say, oh, 10% is nothing. I'm making 50 on NVIDIA or ASML or things like that.
Well understood, but you are still finding those opportunities where you are quite certain you can make 10% plus a year in the agricultural sector.
Well, I think especially in May of this year, there was Archer Daniel Midland trading at a dividend yield of 5%. Now it's already 3.4%, so it went up already 50% or something like that. So that already, as the price goes higher, the return is mathematically lower. But there are these smaller companies, you have to accept the volatility. If there is again a food downturn, it can go lower, which means you just have to buy more. But the businesses are long-term predictable. There is this food cycle that impacts the volatility, but maybe you can accumulate for 2-3 years and then simply enjoy good returns, whether it will be 10, whether you can make 30% next year, or it will be just a 5% dividend for the next 5 years. I don't know, but it's going towards a low risk, long-term positive return, and then what the return will be will depend on the market and on the situation there.
Of course, well understood. The only thing you can focus on is fundamentals. What actually turns out is always a different story. Oil and gas, if one is willing to do the work, one can find plenty of producers trading at, for example, even a 10% dividend yield, especially the smaller producers. Is that something that's on your radar? Is oil cheap enough?
I think oil is cheap compared to the prices we have seen 2-3 years ago. However, 2 years ago when oil was at 100, everyone was really flushed with cash flows, and same with gold miners, same with all these cyclicals, commodity stocks. When they have the money, they invest for growth. And when they invest for growth, it simply means oversupply in the future, which means weakness for the sector. And we are now oil at 60, which is far from the 100s or even projections of even higher on things like that. So we are on the cheaper side. I think I'm looking at this Norwegian producer of oil that has extremely low production costs, but the taxes in Norway are high, so the profits are not proportional. However, they are paying a 9% dividend yield, and they make the calculation as long as oil is above 40, they will keep on paying the 9% dividend. Of course, China demand for oil has peaked, which means there are some structural, let's say, weaknesses in that demand. And now the question is, okay, how cheap do I want oil to be really cheap so that I have a 2020 situation where I know I can't lose money and the upside is significant? I still think that 60 should be perhaps the long-term average, which means that below 50, we are talking margin of safety prices. And below 50, I don't know, Occidental, Warren Buffett's play, is already down significantly over the last months, because at 50, they don't really make profits. At 55, they don't have positive cash flows, which changes the game for a lot of the oil players.
So if I understand it correctly, we are getting to a region where oil is attractive. You're taking a position slowly, but it's not a margin of safety area yet where you can really allocate a large portion of your portfolio with relatively low risk.
I have this educational diversified portfolio where I'm trying to put, because I think that you need to own a stock to know it. So I'm trying to put as many positions that I find interesting. And oil is, for example, a mid position, so 3% of the portfolio. If it goes lower, another 30-40%, then I can buy again and then perhaps buy even again if it goes even lower. However, I have exposure, let's say, there is a good 9% dividend. I'm not complaining on that. I can reinvest it. And if it goes lower, I can buy more. If it goes higher, I make some profits. So at this level, it's good for a mid-position portfolio position. You have to accept the volatility and then play around with it while you're hopefully being paid for owning it through a dividend.
There are these hubs in North America where these shale oil producers are selling their natural gas for incredibly low prices, sometimes even negative prices. And you have these producers that are still profitable just based on their oil. Is that something that you're looking at, and is that something of interest to you?
I haven't looked at natural gas for a while, so I don't know. I know that with low prices, even their production costs go up on oil. Therefore, it makes the situation tricky there. Plus, there are these political relations there, LNG, things like that, that as soon as it gets too political, I'm not that interested because too many risks from crazy shocks.
Understood. Perhaps iron ore, if you look at some of the majors there, for example, Vale is currently trading at almost a 10% dividend yield with also a PE of 10. Is that something that might be of interest of you?
If you look at the cost curve of these producers, you can see that all the big four producers, the Vales, the BHPs, the Rio Tinto, the Fortesque, they have a production cost iron ore of 40, delivered in China. And only the end part of the curve is extremely steep, where still the expensive producers keep the prices higher. And for now, this happens, that happens, and iron ore prices are still high. We haven't seen a recession, a proper global recession, for 15, 16 years. So all these commodities, especially iron ore, give me a good recession. Give me iron ore prices of 50, 40, because everybody is investing in growth. And as we said, with oil, China demand is slowing down. And I would not be surprised that when the next recession comes, and you never know when it will come, I need one opportunity in a decade to invest in something like this. And when that opportunity comes, when iron ore is in 50, when Vale is not paying a dividend, when they are having a negative P ratio, then I might look at these iron ore producers. So for now, they are enjoying this benefit of stability for a while, and everything looks good, but the risks are there, especially because they are producing so cheaply. And there are these new mines coming on in Africa here and there. There is plenty of iron ore, and that is a risk. If there is a recession, that's quickly oversupply, and then you are in an ugly situation.
I guess that's the hard part about playing cyclicals, that they look expensive when they're actually cheap, and they look cheap when they're actually expensive, right?
That's when you work with these cyclicals, the best buy is when it looks ugly. When it's the companies, you say this is going bankrupt. That is the best time to buy. When you see, wow, that's a great dividend, they are increasing the dividend by 5%, the yield is good, the cash flows are good, they are doing buybacks, they are investing in growth, that's the worst time to buy a cyclical or a commodity stock. And I think there was this chart made analysis from Bernstein. If you look at the average free cash flows, usually they bottom at 20% average over 10 years free cash flow yield. So BHP is now trading at a free cash flow yield of, 7, 8%, which means the downside in a downturn is for it to crash 75%. And then when the average free cash flow yield over time is 20%, then you can start picking those up with the margin of safety. You know, demand is there, it's going to be there. The market will rebound when the recession passes, but everyone is so short-term oriented. And here and there, these opportunities arise. You just need to be patient to get to them.
And that mentality is something I would love to talk about in a second, so I'll pause that thought. 3 other commodities that might be hated to a sense could be nickel, vanadium, and zinc. Relatively small commodities, but if you're looking at the price charts, they're all down, and producers might be struggling. Are those places that you're willing to go to find value?
I think it's hard to find investments that give you clean exposure without specific risks. if you look at a specific, nickel mine in Sweden, you can have ecologists, Greta Thunberg, closing your mine and your money is gone. If you go to Africa, when they start making money, the government says, oh, you are going to give the extra profits to me. Or you go to South America, things like that. So it's very hard to find good investments without the risks. Maybe if there is a big diversified player that has these production as, let's say, as I said, with gold as byproducts, that is now not even recognized by the market, but then when things revert, then you might do well. So diversified producers, I don't know, like Glencore or things like that.
Excellent. I would love to transition to healthcare for a second. I'm sure you've seen this as well. Warren Buffett has recently taken a position in United Health, of course, a large healthcare insurance provider that all have seen a rise in cost potentially temporarily for this year, 2025, that might be resolved next year already. Like I mentioned, Warren Buffett took up a position in the space. There's multiple smaller companies that are still depressed. Is that something that has been on your radar?
No. I have made insurance and banking. I have said that's not in my circle of competence. It is certainly in Warren Buffett's circle of competence. However, whenever Warren Buffett or Berkshire take a position, I have made an analysis. I have looked at the last 30 years of Berkshire portfolios, and they buy 10 stocks, they own a stock, they likely talk to management to get really a feeling. They want to own a stock to know it, and then they sell 9 out of the 10 stocks if they are not happy with what's going on and if it's not aligned with Berkshire's management strategy and requirements. So Buffett taking a position in 90% of the cases means he will close the position once he has interacted with management, because every management wants Berkshire as a shareholder, as a stakeholder. Look, Warren Buffett is investing in us, great. And he gets the call, they get the analysis, they get the deeper insights, and then they know, okay, no, sell. They have sold Tesco, they have sold IBM, and 90% of the companies they own, they sell after a while. So that is the risk there. We don't know whether this is just a learning position or something that they might, take over in the future.
That's an incredibly interesting take, Sven. Thank you for sharing that research. But broader healthcare, perhaps, even if you look at, for example, a Pfizer, a really large company, they're trading at a relatively low PE. I believe it's around 10. Is that something that might entice you?
And also pharma, there is always this new drug around the corner, but this or that player, and then they try to chase growth. As their patents expire, become generics, their profits are gone. So it's extremely, extremely hard to invest in pharmaceuticals. You really need to be a specialist. Okay, I have devoted my life to analyzing pharmaceuticals, looking at the opportunities there. And then when there is no opportunity, you have to be able to say, there is nothing to invest in. But if you have spent so much research doing that, then that's very hard to do. So that's the risk of these sectors.
Circle of competence remains important.
Yeah, that's essential. So it's not mine. I just see so much volatility, which means I cannot have an edge. I cannot have an advantage. I don't have a medical degree. I have no idea what that means when I read. So simply impossible for me to analyze.
What about international exposure? When one looks, for example, at the Canadian dollar, it looks to be relatively weak compared to the euro and the US dollar. I mean, even the US dollar is relatively weak compared to the euro. Does that allow for some interesting bargains as an investor to look in these countries where your currency of choice has more buying power?
I have looked at now some companies in Canada, and even in Canada, it's North America, and things are pretty expensive. it is not worth to go there, because if you look at these companies, yes, the stock price is in Canadian dollars. However, their operating currency, if they're oil, if they're this, it's always the US dollar. So one is the stock price currency, and the other is the operating business currency. Because if they are going to lay a pipeline or do something in Canada, the capex will be priced in US dollars, depending on iron ore or steel. So it's really hard to get just diversification by buying another stock in another currency. Also, European businesses, global businesses, therefore they do business in a lot of currencies. If you look at US businesses, I think 40%, 41% of the S&P 500 is international revenues. So also there it is diversified. So as a value investor, you don't really look at currencies. You look at value no matter the currency.
Well understood. And you mentioned earlier on the interview China exposure. I suspect in the past you found some value to be found there. However, you're slowly exiting the position, if I understand it correctly. Why is that?
Well, 2 years ago, people were saying China was uninvestable. And I don't know, Alibaba was trading at a market cap of 200 billion. Of that, 60 billion was in cash. There was no debt. And they were making 20 billion on free cash flows per year, that they started doing buybacks, paying a dividend, and still growing that ecosystem globally. So that was a great return, rewarding the shareholder, and extremely cheap for the position that company had in China. But everybody was saying it's uninvestable, China risk, they will take your money, it's crazy Bermuda stock holding structure, you don't own anything, you cannot invest in China. 2 years later, now everybody is excited about Alibaba, AI, things like that, China stimulus, and the two stocks I had there went up 100%. I look at the fundamentals. Yes, one was a cyclical paper company that is improving, but if the cycle reverts back, I'm down again 50%, and that's not something. So, plus all the risks that people were mentioning 2 years ago, it's still there. It's still China. It's still communist. It's still government managed, and so on and so on. And it still can invade Taiwan. But now everybody's making money and nobody cares about the risks anymore.
All right. We talked about mentality for a second earlier, the importance of patience. I would love to continue that chat. More specifically, whenever you buy a contrarian asset, a hated asset, as a value investor, it always seems to drop more. How do you stay the course?
You have to look at the fundamentals. You have to know what you are buying. And if you know that there is value in what you are buying, you don't care about the price. If it goes lower, you're actually more excited because you can buy more for lower, and the value is there, especially if the business keeps on compounding. They can buy back shares perhaps and create even more value for you. So you stay the course because you're getting more excited because you're getting it cheaper and cheaper if the market doesn't recognize it. But you have to make sure that you are buying value from the start, not gamble. This might be value, this might not be value.
All right, well understood. At some point, of course, you're going to allocate the full position and you're kind of out of dry powder for the specific position. What then?
Well, then you can always rotate from something else. You have the dividends that you can always reinvest in the cheapest option. And these people think, okay, now I'm in a full position, but if I get a little bit of dividends here, I add it to the position and I double the compounding on that dividend. So that's patience. I don't need to do crazy things. And then also most of the retail investors that are saving for their future, they invest on a monthly basis, so they're always adding to their portfolios. And maybe they will say to their spouses, no, we're not going to buy a new car. This old Hyundai will be good in another year. Let's put it in this stock.
Excellent. I would love to ask another question on really what is your most hardest learned question? Hardest learned lesson, the most painful learned lesson.
The most painfully learned lesson is that it's easy. It's very easy to get caught by exuberance and growth. Because you look at the business, it has been doing great for the last 10 years. You look at those growth rates and you say, it can't be this good. Perhaps the stock isn't doing that well. How is this possible? And then over time, that growth rate keeps on declining. The stock keeps on going down and down. And you really have to work hard to get out of such, let's say, exuberant estimations. Because we are looking at NVIDIA now, and it's growing at 40% per year. You look at the sixth slide on their investor presentation deck, and they are showing 40% per year targeted growth up to 2030. And you look at the past, it's growing 40%, and they say they will continue to grow. And if you base your valuation on growth, that's overweighing everything else. And it's so easy to get, let's say, caught up by those valuations. You think is a bargain, and then you make a mistake. So 2021, everything was growing, everything was exploding, and I also attached too much of my valuation process to that growth.
Really interesting lesson, of course. Those growth rates will compound very quickly, especially if you're talking about double-digit numbers, and that can definitely skew your valuation models. And
it's the excitement, the growth, that it's very easy to get caught up to it. The whole market is caught up to those growth numbers now.
Sven, please talk to us about the Sven Carlin research platform.
So that's what I do. I have a YouTube channel where I say it's mostly educational. We discuss interesting stocks, but the bulk of what I do is my research. I have a research platform. I have approximately of around 30 stocks that I cover closely. I update on earnings, and I look at many sectors that I say, okay, when, I don't know, iron ore hits 50, I will then look at all the iron ore players. So 20, 30 stocks closely, and then many sectors from all the cyclicals, all the commodities that I look at, cover, and from that I source 20-something businesses for my diversified portfolio. Again, a learning portfolio, but people want some of my customers want diversification, so I do that for them. Then I have a model portfolio which has about 9 positions, which is, I think, not too much, but not too little from the diversification side. And then I also show what I do with my own money based on the research I do. I send an email usually every week on what I have done with research, update on earnings. I buy something every month for my model portfolio as their monthly inflows. And for now, I've been doing it for more than 7 years, the portfolio there in the research platform. The research is compounding. The value investing portfolio is also compounding, just a bit shy of 15% per year over the last 7 years. So I'm in line with the market, but the P ratio of my portfolio is 10. The market's it's 30 something. So I'm okay with being in line with the market for the next 10 years on my value investment principles.
Sven, thank you so much for your time and your insights today. Really appreciate it.
Thank you for having me. It was a pleasure.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties. that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.